Hello, everybody. Welcome to today's Self-Directed IRA Saturday class. My name is Colin Taylor. I'll be the introer today, and we have Lauren Wells with us, who's going to be talking about navigating non-equity real estate. So Lauren truly is a wealth of knowledge, a great friend of Quest. She's actually the co-founder and chief strategy officer of 7E Investments. She has experience spanning over a decade, not only in business development, sales, but also project management. Laura has kind of been very instrumental in cultivating relationships with more than 600 investors. And actually, prior to founding 7E, she served as a senior consultant with some leading SaaS startups like Procore, LinkedIn, groups of that nature. She not only does investing and helping other real estate investors, but is also an avid real estate investor herself, going back to 2010. Outside of that, her management and growth of diverse portfolios comprising of over 100 assets, which includes both residential real estate and mortgage notes. So we're going to go ahead and bring Lauren up. And while I do this, I forgot to share my slides. This is Lauren. Lauren, welcome. We're so glad to have you here, and really looking forward to hearing you present a little bit. And I know that you're going to bring just a wealth of information to our platform as well. So we're excited about that.
Yeah, happy to be here and love Quest. So happy to have the chance to speak.
Yeah, absolutely. A couple things I do want to say before we get started. Just a really quick disclaimer. And if y'all are familiar with Quest, right, you guys have probably heard this 100 times. We say it with every webinar, every presentation we do. But we are not in the business necessarily of providing any sort of tax, legal, investment, or deal structuring advice. We don't endorse any particular investment. So this webinar truly is for educational purposes. If you're hopping on with us for the very first time, or maybe you're not too familiar with Quest, just kind of bear this in mind going through that this is truly to expand your knowledge when it comes to real estate and alternative investments. And then the last thing is I know Lauren's is happy to take questions throughout the webinar. We'll also have some time for Q&A at the end. So if y'all do have any questions, please just post them down in the chat in the comments, and I'll get those up to Lauren as we go through. All right. Well, without further ado, I'll just let you take it away.
Awesome. Well, thanks again, Colin, for introducing me, and I'm happy to be here. Great relationship with Quest, and everyone at Quest is awesome. So like you mentioned, if you have any questions, feel free to drop them in the comments, and I'll answer them as I go through them. And if I don't get to them, we can circle back at the end during the Q&A. So that being said, I'm Lauren, and I want to talk about non-equity real estate investment options. So specifically, mortgage notes as a real estate investment option. So a little bit of backstory. I am, like Colin mentioned, the co-founder at 7E Investments. Some of you might have heard my business partner, Chris 7E. He's spoken with Quest quite a few times. Usually we go through these together. So this will be one of my first times actually going through this on my own. And what we do is both Chris and I have a background in purchasing mortgage notes that are secured by single family homes throughout the US. What we like to say is we fix and flip mortgage notes. And I'll kind of talk about that in a little bit more depth here on the next few slides. So I kind of want to back up even further, because I actually probably not too long ago was sitting in probably your seat watching all the webinars on where am I going to invest? There's so many options. What do I invest in? What fits my, investment criteria, my risk tolerance? And again, I'm not here to give any investment advice, but just kind of speak to my experience. So when I was starting out, there was in real estate and alternatives, the scary alternatives word, you had multifamily, oil and gas, short-term, self-storage, long-term, and mortgage notes was probably the not talked about at all. I networked and I heard about mortgage notes through someone in a local real estate investment club. And it appealed to me because I had a history in, buy and hold single family homes, and got into that because I thought it would be super passive, which if anyone on here owns any sort of investment properties, that is absolutely not the case. And so mortgage notes appealed to me because you become the bank. You're not the landlord. You're not dealing with the tenants, the toilets, the termites, as everyone says. You are assuming the position of the bank and accepting payments from borrowers, collecting payments from borrowers. So to talk about the mortgage note industry as a whole, it is a massive market. So I'm always shocked when people have never heard of mortgage notes or mortgage note investing, because really it's a $13 trillion industry with anywhere from about 250 to 500 billion in non-performing debt that is floating. And that's really only what's being reported. So as far as opportunity, there is vast opportunity to play in this space. And then especially now in a downturn market, when we're seeing defaults on the rise, foreclosures on the rise, there's even more opportunity, coming down in terms of assets available. To give you an example, last year in Q1 of 2023, we were seeing about 300 million come across our desk to bid on in a quarter. The first quarter, the second quarter, it was about 300 million a month. By Q3 and Q4 of last year, we were looking at 300 million a week to evaluate in bids that we were able to put out. So, COVID kind of lowered the amount available because of government intervention, but that we saw those floodgates really open throughout last year and are continuing to do so. So lots of opportunity in this space. So what is mortgage note investing? So it is an investment strategy secured by physical real estate. So one of the things when I say non-equity offering, a lot of people who might have invested in a syndication or a fund where you are in an equity position, this is not that. This is a one-on-one investment secured by physical real estate. So note investors buy loans from private lenders, banks, hedge funds, credit unions, or whole loan brokers, and assume the position of the bank. So if any of you listening have ever owned a home, maybe you've received a letter in the mail at some point that says, hey, Chase Bank no longer owns your loan. It was sold to Bank of America. Please send your future payments here. That is essentially a sale of a mortgage from Chase to Bank of America. So at a higher level, that's what that is. And that's what we do. So investors are purchasing these mortgage notes, typically at a significant discount. And I'll tell you why in a bit. And becoming the lender. So they are becoming the person that says, hey, send your future payments here. So as the note holder, the investor has purchased the borrower's future mortgage payments and rights to the repayments according to the terms of that note and mortgage. So there's really two types of notes. When you're looking at bidding on notes, there's two types of notes that you'd probably look at. If you're looking to be super passive, I highly suggest performing notes. Performing is when a borrower is meeting the payment obligations per the terms of their agreement. So they're on time every month. Those can typically be purchased at anywhere from 60 to 90 cents of the outstanding balance, depending on the interest rate. Now, non-performing is what we specialize in, and that's when a borrower has failed to meet their repayment schedules anywhere from 90 days or more past due. So those are typically, as you can imagine, offered at a significant discount, anywhere from 40 to 60% of the outstanding balance. So let's talk about the current asset class in this current economic climate. So private credit is preferred due to rising interest rates. Inflation is leading to higher mortgage defaults, credit card defaults. People are having trouble making payments on cars, car loans, credit card loans, and their home loans. lack of inventory in the housing market. Now, I want you to remember this one because a lot of people think, wait, why would you ever buy a non-performing note if, like, how are you going to get them to repay? Well, this comes into play definitely in a downturn market, but specifically right now, there's a huge lack of inventory when it comes to housing. Rents are way inflated, which is causing more distress on borrowers, and they're willing to come to the table to remedy their current loan situation because they don't have many options. They're not able to go out and, rent a place for probably less than their mortgage if they can even find one. So borrowers are more incentivized to work with lenders in this economic climate. Also, because you're purchasing these notes at such a discount, there is going to be, you're having a lot of equity in what your investment is secured by. So to give you an example, if you have a house that is worth $400,000 and there's a loan on it for $200,000, say it's non-performing, you're buying it at you're buying that $200,000 loan for $100,000. So when you look at it, your investment to value is you're into that $400,000 asset for $100,000. So even if that home value was to drop significantly, you're still covered. You still have equity in the home should the borrower not decide to work with you. So, and then really banks right now are focused on liquidity. They're balancing their books, which is leading to more inventory in the market and turning into a lower acquisition cost for people who are interested in, acquiring these mortgage notes. The opposite was true in COVID. Because there was less inventory, anything that hit the market was going for par, maybe 90 cents on the dollar, which really was different for this asset class. So you might be asking, what motivates people to sell notes? What motivates banks, credit unions, hedge funds, other funds? So banks typically want to get non-performing notes off their books. They're, not staffed to manage non-performing assets. I always say banks are really, really good at creating debt. They're awful at managing debt. They don't have the manpower, nor do they have the flexibility to work with borrowers. So, while they could go, and I think a misconception I had when I got into this space was I was always told if you miss a mortgage payment, the bank is going to come and take your home. I've learned that is actually a long, arduous process that isn't really very quick. And so as banks are sitting there losing money on something that's not paying, they'd rather sell it at a discount and go create another loan, creating debt at, 6 or 7%. So that really is it impacts their ability to lend to more qualified borrowers. And then right now, as we're seeing, interest rates again are super high compared to 2-3 years ago. So again, they can sell at a discount and quickly originate a new loan at 7% when they were maybe losing money on a loan at 3%. So lenders on the secondary market. So that's really banks and credit unions. When it comes to the secondary market, you're talking about bigger funds, whole loan traders. They're looking to rebalance their portfolio typically. So they're either closing a fund, they want more liquidity, or they took down a tape, which is basically a glorified Excel spreadsheet of assets that they acquired. And they realize, okay, these 10 don't fit my buy box. And that buy box could be they're not in the states they do business, they're second position versus first position. So there's many ways to kind of invest in mortgage notes, but this is really what motivates sellers to sell those notes on the secondary market. And then from a risk profile, I'm kind of going through the things that I was thinking about when I got into this, the questions that I had, and one of the, again, misconceptions is people wake up one day and say, I'm not going to pay my mortgage. So to give you an example, in our portfolio, the average delinquency is actually 3 years, which most people can't believe. But when we dig into this, when we're doing our due diligence and we're looking at the property and the borrower, really it comes down to these 4 reasons we have here. People fall behind on their mortgage because of health, divorce, death, or job loss. 90% of the time, it falls into one of those 4 buckets. Now, one thing that makes it different from when you're buying at such a discount versus a bank again doesn't have that flexibility to really work with borrowers. you who bought at a discount can go to the borrower and can say, hey, you are behind 30K in arrears. Let's see what we can do to do a trial payment plan. We can extend the term. We can add the arrears to the end. And borrowers are willing to, tell you where they can meet you. And not only are you recouping payments as they're making payments, but you're increasing the value of the loan, which then allows you to sell it back on the secondary market for, if you bought it for, say, 50 cents on the dollar, and you've increased the value because they're now performing and making payments consistently for 6 to 12 months, you can sell it back for, 80, 90 cents on the dollar. So that's kind of that fix and flip model that, our approach is. There are other people that, go the foreclosure route. And I will tell you that is a long, arduous process, especially now with more regulations going into place by the CFPB, which is the Consumer Financial Protection Bureau. So it really is, there is a better ROI if you can get the borrower to come to the table. And again, economic climate today really incentivizes borrowers to do so. So right now, there is a need for higher yields with interest rates and inflation. So people are looking for investments that aren't directly tied to interest rates or the stock market. And really, mortgage notes is, and this is our approach, interest rate agnostic. So when you get this spreadsheet of assets to look at and evaluate and bid, we bid based on a targeted return. So for example, if there is a loan that's written at 6% and we're looking for a 12% yield, we're going to need a 50% discount to make those numbers work. If the loan's written at 9% and we are looking for a 12% yield, we're going to need a 25% discount. So really, interest rate is a factor, but you're adjusting your bids based on your projected yield that you're looking for. So for example, I kind of gave that example. So unlike other asset class, again, the returns are compressed as interest rates rise due to the amount of leverage. So you're buying at such a discount that it doesn't really matter. You have that leverage in the property. So in the case that the borrower says, I do not want to work with you, I'll never make another payment, I haven't made a payment in 7 years, you do have the option, and I'll get to this in a second, on how you make money in mortgage notes to exit through the property. So why mortgage notes? You become the bank, you're not the landlord. There is profitability in varying market conditions. So, profits increase in a downturn market because prices decrease, acquisition prices decrease, which allows for more flexibility when you're going to work with those borrowers to create repayment plans. Collateral, real estate is what it is backed by. It is a physical asset. So it's not like a stock that is backed by very little collateral and have high volatility. A note is less volatile and it's secured by that physical property. In our case, first, single family homes. And then numerous exit strategies. So this is something that attracted me to mortgage notes. There's not just one way to make a profit. You'll see that in a second when I talk about the different ways, the different arms of how you make money in mortgage notes. But it mitigates risk. If you have multiple different exit strategies, and whether you're investing in a fund, which then your risk is even more or less because you're investing in a portfolio of assets, or you're investing, in a single note, you have more options available to you than, a value add, for example, where I'm going to buy this, I'm going to rehab it, and I'm going to refi and, make my money that way. What happens if interest rates rise? We're seeing that a lot in the value add space, even the short-term rental space. So you have the ability here with mortgage notes to really pivot and adjust based on borrower's situation, economic conditions, and what you're looking for in terms of yield. So how note investing works, i.e. how you make money in note investing, what everyone wants to know. So typically it starts with buying those loans I'm using single family homes. Again, you can go commercial. There's, also second position notes. But for this example, I'll talk to what I specifically do, we specifically do. So buying loans on single family homes at a discount to the unpaid balance. And then there's really three kind of exits here. The first is liquidate those undesirables in a tranche. So if you say had to buy 2 notes or 5 notes, because sometimes you can't pick an individual single note, a seller will require you to take down, all 5. Now you say, okay, 4 of these are great. They fit my buy box. I'm going to take down all 5. So you're liquidating that undesirable, and it's not necessarily a bad loan, but it might be something that doesn't fit your buy box. You go to the secondary market and you quickly flip that loan for a profit. And that is your first exit strategy. That's a very small percentage. I would say about 1%. The bread and butter, I guess, of what we do is right here, the negotiating the payment schedule with the borrower. So that's your typical fix and flip of the mortgage note. You're buying it at a discount, let's say 50%. You're going to the borrower, you're saying, hey, sending that demand letter, you're getting them to come to the table, figuring out how you can restructure the loan. Is that, hey, we'll do a trial payment plan for 6 months. And if you can meet all those deadlines at your current payment, then we'll, add the rest of your arrears and extend the term. Will they make quarterly payments towards their past due? There's, again, a lot of flexibility and creativity that can go into working with the borrower. You're generating payments, cash flow from those payments. And then once it's been seasoned, meaning payments have been made for anywhere from 6 to 12 months, you're going to sell that loan back on the secondary market as performing. So again, increasing the value of the loan and flipping it for a profit. The borrower could sell the home or pay off the loan, or they could refinance. Now, as you can imagine, right now, there's not as many borrowers selling or refinancing because their interest rates typically are significantly lower. During COVID, though, we were getting payoffs left and right. We saw borrowers refinancing all the time. Right now, it's a lot of us doing that fix and flip model. So if people are looking to get into this, that's probably what I would expect more often than not. And then really the third, and this probably for us makes up about 10% of our portfolio, is exiting through the property. So taking ownership of the home, meaning the borrower has refused to come to the table. The borrower is deceased. The family inherited the property and doesn't want anything to do with it. So exiting through the property, whether you're going through that foreclosure process, doing some sort of deed in lieu or cash for keys. And in our instance, we sell the asset. We're not in the business of, again, becoming landlords. But I do know people who are individual note investors that will hold on to the property. They paid $100,000 for that property that's worth $400,000. They take back the property and they rent it out. So it really kind of just depends on, again, what you're looking for in an investment. So risk mitigation and due diligence. This, if you read, I'm sure if you're listening to this and you go Google books to read on mortgage note investing, I can promise you they oversimplify every aspect of it. As someone who got into this after reading all those books, when you purchase assets, it's similar to buying a home. So what I mean by that is you're going to get a Excel spreadsheet or a tape of loans where it has, the borrower's first name, last name, the outstanding loan balance, the principal and interest due, the last payment they made, any legal going on, value of the property address, all the information on loan you could possibly want. Now, it's not a very quick process. You get to go through first and put in what's called an indicative bid. Typically, when you're doing an indicative bid, you're going to look for bidding based off of yield. And so what's the property value? What's the current interest rate? And what am I looking for as a return? You're putting those indicative bids in on the assets that you're interested in. And then similar to, putting an offer into a house, and the seller will then come back and say, okay, this fits let's go, let's move forward into due diligence or escrow. They'll say, no, we want to counter, or, no, we don't accept your bid at all. So once you have come to an agreement on bid price, an indicative bid price, you then enter into that escrow period or that due diligence period where you're going through and able to really evaluate everything. So for example, the property, you're making sure that the value that was stated, it's kind of a trust but verify due diligence. So if you want to make sure the property is worth what it says on that spreadsheet, so you're getting a BPO on the property to make sure that someone in that area says, yes, it's, it is worth this. You're looking into the borrower. Is this someone who has a history of filing bankruptcy? Probably not a loan you're going to want to take on. It is higher risk if someone's filed bankruptcy a ton. You're looking into what is their credit. You're looking at servicing notes to assess the situation. So servicing notes are essentially notes kept by the servicer of record, who essentially is the one collecting payments on the loan prior to you if you were to acquire it. And those notes are gold. You're able to see, okay, they were making payments and then all of a sudden it just stopped. Typically the servicer will reach out to them and try to, get them to continue with their payments. And you're able to see, oh, they stopped making payments because, they lost their job or COVID, or they were going through a divorce. So getting that insight into what happened is also extremely useful, because you're assessing, looking at the borrower in the situation, what is their ability to repay? And not just their ability, will they come to the table? Like, are they going to be open to communication? So that due diligence period allows you to do that, as well as, verify it's actually, in fact, a first trust. Verify that the mortgage and note are in the name of the right person. Sometimes there's, errors when it goes to recording the property. So, again, doing all the due diligence and making sure that you know what you're getting. And say you come back to the seller and say, hey, these 5 assets of the 10 that I bid on are 50% of the value you listed. You can then fade your bid accordingly, and the borrower has the right to say, yes, or the seller has the right to say yes or no to move forward. Once the agreement is set on the final bids, you then close escrow and onboard the loans. So again, it's not those sound good, I'm going to bid and take over. There's a thorough due diligence period. So I kind of want to walk through what some case studies look like of loans that we actually have worked out or are working on. So we have a property that we purchased in August of 2022. The borrower had renovated the property and listed it for sale, but the property was sitting on the market. We have a financial model that we ran this through and saw that if this was sold within 48 months, it would yield the targeted return. So you can see on the left, we acquired this $123,000 loan for $80,000, and the value of the home was $500,000. The property was sold in April of 2023, and the loan was paid off. So again, we were looking at 48 months, which is why, modeling your financial models are really important. But again, we were paid off, less than 8 months later. This is probably more of an example of, I would say, what an average fix and flip bread and butter loan in our portfolio looks like. It's the Phoenix payment plan is what we call it. We purchased this in May of 2023. Our servicer of record was unable to contact the borrower, so we sent that demand letter in June. And for those of you who might not know, a demand letter is the first step in a foreclosure process, sent by an attorney, and typically does get the borrower to come to the table and realize this is serious. So as of 11/6, so November, the borrower has made over $6,000 in payments. So you can see, that's 12.5% of the acquisition price in just 5 months. And they've agreed to make double payments every month until they are current. So this is an example of someone who we weren't able to get a hold of. We started that foreclosure process. They came to the table and they are now getting caught back up. And once those payments have been made, probably for about another 4 or 5 months or so, we will be able to sell back onto the secondary market for a profit. And then you have this one where we purchased it in October of 2022, worked with the borrower. And this was actually something that a lot of people don't know, is there are a lot of HAF, Home Assistance Fund programs by the state, where because of COVID or whatever, they can get funds for past due payments. So we worked with the servicing company and the borrower and assisted them in getting half. And so we to date have received over 11,000 for this that we only purchased for 9, and the loan is now performing and was sold for $10,000. So not only did we get that 11,000, but it was also sold for $10,000. So as a performing note. So those are some case studies. And then I know Colin also wanted to go ahead and probably say some more stuff before I take any Q&A.
Okay. Yes. Thank you so much, Lauren. That was fantastic. So just really quick before we do get into some questions, and any questions that y'all have, please continue to put those down in the chat and we'll get those to Lauren here shortly. So first thing is, if you're, interested in maybe learning about how to utilize a self-directed IRA for, potentially mortgage note investing, maybe investing with a group like 70, which I'd be happy to have Lauren talk about here a little bit more here shortly. Let us know. I mean, if you don't know who Quest is, maybe you just found our webinar surfing the internet or something like that. We are a self-directed custodian. Essentially, the way that I like to describe it is we are enabling individuals to take control of their retirement funds, whether you've got it in an old 401k, other IRAs, or something like that. Take that money and move it to a more private or alternative asset custodians, such as Quest, right? A self-directed custodian where you can invest in these things and still have the same tax advantages that you typically would purchasing stocks or mutual funds with a public brokerage, right? So that's kind of the advantage that we offer to investors. If you're interested in learning more about that, learning about how to do this specifically with your IRA, please let me know. Let one of our IRA specialists know. We'd be happy to sit down, have a completely free consultation with you. You can take down our information. You can scan that QR code. It'll take you right to our calendar to schedule an appointment. So please let us know if we can help. One thing that Quest really does what we pride ourselves on is our education. So we host a lot of different events where we are supplying education to not only our clients, but the general community, and especially the real estate investor population. So obviously this is a webinar that we do once a week, self-directed Saturday. It happens every Saturday, 12 p.m. Central Time, 12 to 1. We also do a Power Play Tuesday, which kind of in a very similar, space. It's different topics every week, right? But those are 12 p.m. to 1 p.m. Central Time every Tuesday. Very much the same platform. We have in-person socials and we actually have one coming up not only in the Houston office, but also in our Dallas office that I'll mention here in just a second. National Networking Happy Hours is kind of a medium that we use for online networking. All of our in-person events, we try to promote networking as much as possible, as Lauren could tell you as well how important that is, specifically for real estate investors and people who maybe either have 100 properties under their belt or flips, or they're just getting into the industry, right? It's your network is your net worth, as a lot of people like to say. So I think that really holds true. So networking happy hour, you can join that online. We have people from all over the country who, from service providers to investment sponsors to private lenders and borrowers, right? There's all kinds of people there. So can really be a great way to make some connections. And then the other thing is you can watch all of our past recorded webinars on our YouTube channel. So this one will probably be uploaded, I would say, within a few minutes after we conclude here today. I would encourage you all to go check out some of the other webinars that we've put out. Like I said, we do 2 a week, and sometimes we're putting out additional education outside of that too. So those are some really great resources. So this is if y'all are in the Texas area, whether in Houston or in Dallas. Austin was actually last week, so hopefully for those of you around the Austin area, you already made it out for that one. But we have 2 more socials coming up. February, kind of in the theme of Valentine's Day, we are doing our education portion of our socials about the dynamic duos. So it's kind of a panel. We've got a few different couples that are real estate investors together or business partners to some capacity, to talk about how they manage their relationships, how they separate work from work and business from personal and home life, right? And so they're really there to kind of give guidance on their experiences, what they've seen. Nathan Long, the president of Quest Trust, is actually going to be moderating both of these panels. So he'll be in Houston and in Dallas. If y'all know Quest at all, I'm sure you know Nathan. He's really a wealth of knowledge, a very experienced real estate investor himself as well. So I would highly encourage y'all to check these out. We'll have food, drinks. There will be, like I said, networking, right? You can scan that QR code there. And I think Kamea's has shared a link in the chat as well for our events page on our website. You can scan the QR code and register there. The final one, actually second to last event that we have here, is going to be in March. We're calling this the Path to Wealth for the Next Generation. So this is, kind of a space for millennial investors to really learn, younger individuals to learn about the real estate space. We're actually going to be having Lauren back for one of our panels. So this will be March 23rd. We're going to have 3 different panels throughout the day, which I think we're still, I'm not sure if we have the topics on that yet or not, but specifically targeted to younger individuals who are trying to learn how to invest, how to build their wealth bucket, right? So we're really looking forward to this one. I'll be one of the moderators on there as well. And you can scan the QR code to register for that. The very last one that we have here is the Quest Expo. The expo, if y'all have not attended specifically a Quest Expo before, these are really wonderful events. We typically host them about every other year. So the last time we did one was in September of 2022. We had, I want to say, just over 800 attendees there. There was, probably 50 plus different speakers and experts. And we had, a ton of vendors and sponsors who were also there kind of playing their role, right? But it was, so this one will be very much the same, right? It's going to be June 27th through 29th, which is a Thursday through Saturday. It'll be in Las Colinas, Texas. So it's in the Dallas-Fort Worth area, I believe, just north of Fort Worth. And if you're flying into the Loveland airport to get there, it's like a 15-minute drive. So we're going to have people coming in from all over the country. We're selling tickets like crazy already, kind of after just really starting in the new year, or kind of hitting it harder in the new year. And we're hoping to have over 1,000 attendees this year. So this is going to be a huge event. The venue space is absolutely beautiful. I haven't had the chance to tour it yet, but we've kind of done some like virtual look-throughs. And so I'm actually a part of our expo planning committee. We're really excited kind of about what's all coming up. So highly encourage y'all to look into that. You can purchase your tickets online. Kamea shared a link to the expo ticket purchase where you can look at our website, look at the potential topics and things that you'll have kind of at your fingertips. So it's going to be a really good one. We're looking forward to that. But that is about all I have.
I saw some questions come in, but also kudos to Quest. We're so bummed that you did not do Quest Expo last year.
I know,
because 2022 was amazing, super educational. Both as on the sponsor side, but also as an investor myself. So if you're in the area or interested in just learning more, I definitely recommend attending. I've been to a lot of conferences and events, and it's up there. It's up there.
Yeah. Thanks for the kind words, Lauren.
Yeah.
We're really looking forward to this one. It's going to be the biggest and best yet. So, okay, let's.
Yeah, I saw some questions. So
hop into some Q&A now.
Yeah. Ed Oh, okay. There you go. Oh, that's cool.
I'll just put them up for you.
Since you're dealing with homeowner mortgages, do Dodd-Frank or licensing restrictions apply? Yes, they do, which is why we use a licensed servicer. You can typically the servicing companies will charge a fee, either a flat fee or a percentage or like kind of fees based off of different services they do for you, but they are licensed in each state and they are to comply with Dodd-Frank. So they're doing the outreach to the borrowers and they're the ones who that licensing will apply to. There are some states in which the lender also has to be licensed, and in those states we are licensed.
Awesome.
The tape. This is always the question. This was my first question. Great. So how do I get access to these notes? So really it's as you can imagine, because you probably haven't heard of mortgage notes very often, it is a very small niche asset class and community. So really networking with people who are in the mortgage note space, learning about different funds who are selling and getting on their lists, sellers lists. So for example, we have a list you can join. There's a few other kind of bigger brokers as well that will send out tapes quite often. If you want, you can email me directly and I can maybe give you a few names. You can just I think my email is on the last slide, but it's lauren@7einvestments.com. But really it's about building those relationships in the community, because one of the things that sellers are very hesitant is a new buyer, because there are so many licensing rules and regulations. If the buyer, if they sell to someone and that person doesn't follow servicing rules or licensing restrictions, it can come back to them. So if there's any legal, it can kind of come back to them. So making sure that if you're there, you're, building those relationships as someone who is going to follow through not only in your bids, but also, knows kind of the rules of how to engage with borrowers legally.
Yeah, absolutely. I figured I'd just put this one up because it was
a
good segue.
Yeah. So sometimes I kind of answered this like 5 seconds ago, but also a little bit more. Sometimes people will say you have to buy the whole tape of 100. You can't just cherry pick. However, in the, funds if you're getting on a list of funds who are selling assets, it's probably a place I would start is see mortgage note funds, say, hey, do you ever sell? Can I get on your list? They'll probably have you sign an NDA and then you'll get to see what they're liquidating. Now, most of those will allow you to cherry pick. So not have to take down the whole tape.
Interesting. Okay. Let's see. We have a question here from David.
Yeah. So isn't it true that most of these notes are on the list in the secondary market because they've been rejected by institutional buyers? No, that's not necessarily the case. Sometimes, again, they're rebalancing their portfolio. They want more liquidity. They took down a massive tape of 1,000 loans and, 500 of them don't fit their buy box, but they're BlackRock and they can do what they want. So, yeah, not necessarily.
Okay. Do the lists you get have predominantly non-performing notes that aren't good?
No, we actually see, I'd say it's about 40% of what we see is performing. The other 60% is not performing and then aren't good. I guess that's really eye of the beholder and what your buy box is and risk tolerance. They're not, I guess when you say not good, I'm going to assume that you're thinking these are all deadbeats that haven't paid in 20 years. And that's definitely not the case. I think if people like that stereotype, that's better for us because there's more opportunity, but that's definitely not the case. And sometimes we'll get tapes that are predominantly or that are only performing. Sometimes we'll get tapes that are a mix and sometimes we'll get only non-performing. So it just it kind of is a good mix. Yeah.
One, I think last question here from David too.
Do you look for individual notes and do you work with note brokers who bring in one-offs? We do look at individual notes and we do have broker relationships that do bring us notes. So yes.
Okay. All right. Joseph asked, if we work with you, do we deposit a lump sum with you and then 70 uses that to be a part of, let's say, 100 mortgage notes that you manage?
Correct. So we have a fund, a Regulation A plus and a Regulation D 506C offerings. They both have minimums. The Reg A is open to accredited and non-accredited investors with a lower minimum. And essentially, yes, if you invest, you are investing with us into the entire portfolio. So again, it's a way to mitigate risk. You're not tied to the outcome of an individual note. Right now, we have just under 100 notes in our portfolio and about 56 million in asset value. So, and over what's 500 investors maybe?
Mm-hmm.
Yeah.
Yeah. And I know this question kind of goes along the same line of thinking, but how would they, find out more information or get in touch with you? What does that look like?
Yeah. So definitely head to our website. I think something that we do a little bit differently, and Colin might be able to attest to this, is, we really focus a lot on the education of who we are, what we do, and how we do it. We run monthly webinars talking about this, and then all those webinars are posted on our website as well. So 7einvestments.com. And then you'll be able to go to the resources and see webinars, case studies, track record, all of that. But if you're kind of interested in seeing what we have going on, I would recommend joining our email list. And you can find that under newsletters. You'll be able to enter your email. We are not like crazy emailing you all the time. We email a case study a week, and then we invite you to webinars that we host. Again, we host monthly webinars. The next one is coming up the 13th of February, and that one is a Ask Us Anything. So if you attend that, I definitely would watch a prior webinar because you'll probably have a ton more questions after doing that. But that would be the way to learn more about us. And then there is also the option to speak with a member of our team. So we do not offer investment advice. However, we can answer any questions you have about our fund and our offering and what it looks like to work with us. So.
Yeah, and I will say one thing that I do really love about you guys is y'all's focus on education too. I mean, I think it's something that we mutually share, right? As
well, you want people to feel like as someone who got involved in investing in 2010, I felt like I was building my own ship and I didn't know all the answers and trying to find all the information. And as an investor, you want to feel confident in who you're investing with and and understand it. So, a big part of what we do is that education. And, even people who have come to us looking to invest on their own and get on our sellers list, they might do that and then realize they don't want to do that and invest with us. So, it really, I highly encourage checking out our website and our previous webinars. We just did one last month that was, I would say, probably the most comprehensive about who we are, Chris's backstory, my backstory, how the funds came to be, and our specific offering.
Yeah.
Oh, I love it. Yes. So 2 options. If you're wanting to have someone talk through the investment process with you, again, go to our website, schedule a call. Everyone that our whole team is in-house. So that's really important to us alongside the education is everyone on the asset management team, acquisition team, investment team is in-house. So we have a team that you can schedule a call with. They'll walk you through that investment process. If you're pretty tech savvy and you want to invest in the Reg A, you can actually go straight to our website and press Invest Now, create an account, fill out the paperwork. If you have an account with Quest, we have a great relationship with them and we'll be able to help facilitate that process. Colin and I actually have never met in person, but we've emailed dozens of times.
Quite a few times, yeah.
Yeah. So you'll be able to, if you have a self-directed IRA, fill it out. We'll take it from there and make it as easy as possible on you. If you're investing outside of that, again, you can just invest directly on our website. That is the beauty of the Regulation A+ offering. Joseph, what have your returns been over the past 5 years? So this is really exciting for me to talk about because one thing I didn't know prior to entering this space on the sponsor and having a bigger fund was we're entering what's called the independent broker dealer market, where we're working now with financial advisors and smaller RIAs and family offices. Well, when you're an individual investor and you ask for a track record verification report, if you can't tell, due diligence is something I'm very passionate about, like investor due diligence. So, a lot of people will look at the website, and we do have our returns for the fund listed on the website. So you can see that on the offering page at the bottom. You'll be able to see what has been paid out. We pay monthly dividends. Now, as a novice investor, I would always ask or look at the website to see, what's your track record been? And you're kind of taking them at face value. And I'm not to say that sponsors lie. That is not great. I think all sponsors have the best intentions when they get into it. But there's some color added. And as an investor, I realized that you can actually ask them if they have what's called a track record verification report. Now, we just got ours completed. Again, I didn't even know about this as a sponsor, that you could request this. And it's basically a third-party report. Ours was done by the Spalding Group, and they essentially go through all of your past funds and verify that what you're publicizing is accurate. They go through the bank statements, and they write up this report that says, we calculated this seems to be correct, or this is off. So we just got that, and I can confidently tell you that all of our funds have met and or exceeded expectations, and our net return to investors has been 14.53%.
Wow. Awesome.
Yeah. Now, those funds, disclaimer, were structured different from these current offerings. These are more income plays versus income plus growth or only growth. But yeah, if you email me again or want to hop on a call, I can kind of look through that report with you or send it over.
Awesome. And one thing I wanted to mention on Dean's question as well, because you kind of mentioned the self-directed aspect.
Yeah.
Certainly, if that's something you're interested in, using your self-directed IRA, Dean, or for anybody to invest with 70, kind of get I would say the relationships started simultaneously, right? Because there's processes with Quest, there's processes with Lauren that you'll have to go through. And getting all of that done, right? Setting up your account and getting it funded before the investment can actually take place. So just wanted to point that out as well.
Yeah. What is the minimum hold time for our investment? So again, we have the two offerings, the Regulation A and the Regulation D. For the Regulation A, the minimum investment is $5,000. The hold time is 4 years. So it's great for people who maybe have just, started a self-directed IRA and don't have, 25, 50, 100,000. So that's 4 years. For the Reg D, as if you are qualified as a accredited investor, it is $100,000 minimum, and it's a 3-year hold. So 2 different options available. You have to be accredited for the Reg D.
Awesome. Okay. Any other questions, everybody? Well, one thing we'll see if anything else is coming through, Lauren. I did want to ask you, because I think this is kind of specifically where your background is. What is it like? I'm sure that y'all have, some markets that y'all target specifically, or at least that you find more popular, right? What is y'all's, process of doing that, or, kind of how do you go through the steps of picking these notes, right?
Yeah. So obviously there's certain states. We're pretty much spread throughout the US. Again, it's another risk thing. We're not tied to any specific market, but so that's a risk mitigation tactic of ours. And because Chris and I had industry experience on our own, we have all those vendors and relationships set up throughout the US, whether it comes to attorneys or realtors or whatever. However, there are states like New York, New Jersey, Pennsylvania, but there's opportunity there because it's just a little bit harder in Pennsylvania. But again, you can get a better discount. So our strategy is really, we don't love New York. We don't love New Jersey. California is not super great. So we try to steer clear of those states. But we know people who love those states. So it works for us when we have a tape of assets that has 2 in New York. And we're like, we can call up XYZ fund or so-and-so investor, and they'll gladly take these. And that's an example of kind of liquidating those undesirables. But for us, it's really, all made on the buy and making sure we're buying the right assets. And what I mean by that is not only can we get them at the price we need, but also, does the borrower have the ability or will they come to the table based on what we're seeing in the servicing notes? We got into due diligence with one that looked great, but we pulled, what's it called? Can't think of the word. Credit report, credit and criminal, and all of that, like we do to do our due diligence on the borrower. And the guy had a 17-page rap sheet. We definitely did not proceed with buying that note. So the due diligence is something that, again, I'm obsessed with both asset due diligence and then investor due diligence. So it's something we have, again, a whole webinar on our website, just on the due diligence process, which we talk through in depth for, I think, like 45 minutes. So definitely check those out.
So it's such a huge piece of investing, especially when you get into like the alternative and private part of our industry.
Yeah.
And you said the Reg A was the newer investment option that you'll have that's on the
Reg A. So if you're not familiar with what a Regulation A+ offering is, it is essentially something. So Reg D is what most syndications are, multifamily. You see those are always 506Cs or 506Bs. And those are, you have to be accredited, and typically you can't market them, or if you can, you have to make sure they're a qualified purchaser. So Reg A, and the SEC, you just submit paperwork. The SEC says, great, you filed that you have this fund. Regulation A goes an extra step, and the SEC actually makes you write basically like the back of a pill bottle that says like, yeah, this will help you, but here are all the things that could go wrong. The SEC makes you write what's called an offering circular. And it's like a PPM, which is a private placement memorandum that the Reg Ds have on steroids. So I think ours is like over 100 pages with all the supplements. They look through that and they have to qualify you. They have to say you are, qualified to present this to the public. And the reason they do that is because we are allowed to accept money from both accredited and non-accredited investors. So the SEC's job is to protect investors. And so that's why it is a pretty strict qualification process. We went through that. We started that process after we closed our prior funds in February of 2022. We were qualified in July. I know people who are looking to get qualified now. That process is like 6+ months, 8+ months. Qualified in July 13th of 2022. And so it is ongoing. We've been raising capital for that ever since. Yeah.
Fantastic.
Yeah.
Okay. Well, if there are no last minute questions, Lauren, thank you so much. It's a pleasure having you on. Like I said, we always love having your group on to kind of educate on our platform as well. Y'all really are just a great resource, and really do a great job at presenting the information and kind of, I think, explaining it in a way that everybody understands. So thank you for your time today.
Yeah. Thanks for having us. We're excited to see you. We'll be at Quest Expo. We reserved that sponsorship so quick. Last June, I was like, wait, this is next June, right? So definitely, if you're on the fence, I would attend Quest Expo. Wealth of knowledge, being around people who are looking at the same things you are. And then, if you have any questions, feel free to reach out to myself. I'm on LinkedIn. Chris is on LinkedIn. Chris 70, Lauren Wells, or feel free to email me directly, lauren@7einvestments.com.
Awesome. And can I just put your information up there too?
Perfect.
Okay. Well, thanks everybody. Contact Quest, contact 7E with more questions you have. And we hope you all enjoy the rest of your Saturday and the rest of your weekend.
Thank you.
All right. Bye, everybody.